If you are new to investing in the stock market, then listen up, because I believe you are extremely vulnerable to making one of the most common mistakes around. You're probably what stock market commentators refer to as a retail investor. That's a non-professional investor that purchases stocks for themselves using third-party brokers. Many new investors use online discount brokers such as Robinhood to invest what little money they have in the stock market and tend to base their investment decisions on personal recommendations and news reports. However, what new investors do not fully appreciate when investing their money is that there is an asymmetrical level of knowledge between themselves and those they are essentially trying to play against. Therefore, if you decide to just dive in, there is a very good chance you will suffer a loss. For someone to gain in the stock market, another person has to lose in some way. For example, because they misjudged the market and bought at an overinflated price. New investors are more likely to make bad investment decisions because they do not yet know how to properly judge the market. This sounds obvious, I know, but the biggest mistake new investors make is to think it won't happen to them and to invest more money than they can afford to lose on an apparently solid but inherently risky stock. As a new investor, it's so easy to invest emotionally for fear of missing out, or because you see investing in stocks as a fast way of changing your life. But the stock market is an arena of risk, where unprepared investors and their money are more than happily consumed. A good analogy is that of diving into an unfamiliar body of water in search of sunken treasure. If you just cannonball or dive from a high diving board, clearly you risk injury because you don't know what lurks beneath the waves. For example, are there fast-moving underwater currents you cannot see? Perhaps there's box jellyfish or great white sharks lying in wait. Who knows? The mistake I would therefore urge you not to make is that of buying stock based on emotion. You should always take your time and know the risks before you enter the market. This means asking questions like, how much do I have to invest? Are my expectations realistic? How much can I afford to lose? How much of a risk is this stock and how can I find out? Etc. You really need to understand fundamental terms such as the price to earnings ratio, earnings per share, beta scores, dividend yields, etc., so that you can make well-informed choices. You should have a clear plan that involves looking at all of your investment options, including lower risk bonds and investor-friendly index funds, which naturally spread the risk by tracking the overall performance of a stock index. Do not buy stocks based solely on Reddit posts, people, or YouTuber recommendations, or online news articles. It's always best to err on the side of caution, because at the end of the day, the stock market is an arena of risk, and it's just as happy to swallow your money whole as delivering you any profits. Remember, be cash bright with your investments, not cash dumb. Thanks for watching. If you found this video to be helpful, please leave a like and don't forget to hit the subscribe button. And until the next time, stay sharp, stay hungry, and stay cash bright.